All right, let's dive right in. We're looking at some fascinating new research from Goldman Sachs, and it points to this massive kind of under-the-radar reversal that's happening in the market. It really feels like a changing of the guard, where these old-school, heavy industries are suddenly making this powerful comeback. And the reason why? Well, it's all thanks to a very, very modern catalyst.
For the better part of a decade, the playbook was just simple, right? Bet on software, bet on data. Basically, bet on anything that could scale to the moon with almost no physical footprint. But that's all changing. All of a sudden, the market is rewarding things you can actually touch. We're talking power grids, infrastructure, heavy machinery. So what on earth is going on, and how is the biggest digital revolution of our time, AI, secretly behind this very, very physical shift?
Okay, so to really get a handle on where the market's headed, we first have to take a quick look back at the era we're just leaving behind. And that was, without a doubt, the undisputed reign of capital-light companies. So think back to the world right after the global financial crisis in '09. We walked into this really unique period. Interest rates, basically zero. That meant money was incredibly cheap and just everywhere. You combine that with the absolute explosion of the digital economy, and boom, you get the perfect storm for a very specific kind of business to just dominate. We're talking about companies built on intangibles, things like code and data, not giant factories. And it got extreme. By the early 2020s, these growth stocks were trading at more than double the valuation of the old-school value stocks.
And this created this really stark divide, right? You had two completely different camps. In one corner, you had the market darlings, software, data, all those digital platforms that could get huge without building a single new factory. And in the other corner, the old economy, manufacturing, infrastructure, all that stuff built on massive physical assets. For years and years, investors just overwhelmingly poured money into the scalable and intangible, and kind of left the physical and concrete behind. But now, that entire playbook is being completely flipped on its head. The world has fundamentally changed, and you better believe the market is changing right along with it. So the big question is, what could possibly be powerful enough to reverse a trend that lasted a decade and seemed totally unstoppable? Well, it wasn't just one thing. It turns out it was a series of pretty powerful shocks to the whole system.
Okay, first off, the entire macro environment just did a 180. We had post-COVID inflation, supply chains were a mess, and all these new geopolitical shifts. It all meant that money suddenly got expensive again. And when that happens, resilience really starts to matter. Then, second, this caused a huge shift in mindset. All those physical things we kind of took for granted, reliable energy, secure supply chains, solid infrastructure, they stopped being seen as boring old commodities. All of a sudden, they were scarce, they were strategic, and they were incredibly valuable assets. And the direct result of all this, that massive valuation premium that capital-light companies enjoyed for a whole decade, poof, it just vanished. The gap has now almost completely closed. And here's the key thing. It's not because tech collapsed. It's because these heavy industries have been revalued so strongly upwards. And if you want to put a number on just how big this reversal is, get this. According to Goldman Sachs, a basket of these capital-intensive companies has outperformed the capital-light ones by a staggering 35% since early 2022. That is a massive shift in market leadership.
But here's the thing. The macroeconomy, that's only half the story. There's another, even more surprising force that's pouring gasoline on this fire. And, kind of ironically, it's coming from the one place you'd think would be purely digital, artificial intelligence. And this creates this absolutely fascinating paradox. AI is basically hitting the market with a powerful 1-2 punch. So on one hand, yeah, it's a disruptive force. It's making people question the long-term value of some traditional software companies. But on the other hand, and this is the really crucial part, AI is creating a colossal and absolutely unprecedented demand for physical, real-world infrastructure.
I mean, this quote from the Goldman Sachs report just captures the irony perfectly. It says that AI is turning the market's most iconic capital-light winners into capital-intensive industrials. Think about that. The biggest tech companies, the poster children of the asset-light era, are now having to spend on physical stuff at a scale that rivals the old industrial giants. The new rule is simple. To lead in AI, you have to build. And how much building are we talking about? Well, hold on to your hats. Between just 2023 and 2026, the top 5 U.S. tech hyperscalers are set to spend $1.5 trillion on capital expenditures. That's mostly for data centers and all the hardware AI needs. Now, to put that in perspective, that's more than double what they invested in their entire history before 2022. They are, quite literally, becoming the world's biggest builders.
Okay, so if the game is changing this much, we obviously need a new way of thinking, a new framework to spot the winners. And that brings us to the absolute core concept from this research. It's a framework they call HALO. That stands for Heavy Assets, Low Obsolescence. Pretty catchy, right? But what it really is, in simple terms, is a way to find businesses that have two key things going for them. First, they're built on massive physical capital. And second, those assets are almost guaranteed to stay essential for a very, very long time, no matter what the next big tech trend is.
So let's just break that down a little more. That first pillar, heavy assets, that's all about having huge barriers to entry. It means it's incredibly expensive, or it takes forever, or it's a regulatory nightmare for anyone else to come in and build what you have. Then you have the second pillar, low obsolescence. This one's easy to grasp. Just think about a national power grid. Its fundamental importance doesn't just vanish because someone launches a new social media app, right? It persists. It's essential.
So what kind of things are we actually talking about here? Well, it's exactly what you'd think. Electrical grids, pipelines, airports, railways. We're also talking about critical industrial machinery, aerospace and defense manufacturing. You get the idea. These are the physical backbones of our entire economy, and it looks like they are officially back in the spotlight.
So, the big question remains, is this just a temporary blip, or is this something bigger, something more structural? Well, let's look at the evidence, because it's really starting to pile up, suggesting we have in fact entered a whole new age that favors heavy industry.
And this chart from the report really paints the picture. It's the visual proof. Along the bottom, you've got how capital-intensive a sector is, basically how heavy it is. And up the side, you see the change in its valuation since early 2022. The trend is just crystal clear, isn't it? The heavier the assets, the more the market has rewarded that sector. I mean, just look at the difference between utilities, way over on the right, and software on the left. It's a huge divergence.
And listen, this isn't just about market sentiment, about what's popular right now. This is about the future. Analysts are now forecasting that these capital-intensive companies are actually going to grow their earnings faster over the next few years. We're talking 14% a year compared to just 10% for their capital-light peers. The whole growth story is shifting.
And it's not just talk. Companies are actually putting their money where their mouth is. After a whole decade of underinvesting in this stuff, they are once again pouring huge amounts of capital back into physical assets. Take Europe, for example. The ratio of capital spending to sales has just hit a 10-year high. This creates this powerful, self-reinforcing wind at the back of the entire Halo thesis.
So what's the bottom line here? It's that in a world that's feeling more uncertain, and with the absolutely massive physical demands of AI, the market's very definition of value is changing. It is shifting back to tangible things. It's rewarding capacity, networks, and infrastructure. All the stuff that is super costly to build, takes a long time, and is nearly impossible to replace.
And that leaves us with one last really fascinating question to chew on. You know, for the last 20 years, the assumption was that value was dematerializing, right? It was all moving into the cloud. But what if the exact opposite is starting to happen? As AI makes digital intelligence almost infinitely abundant, could it be that the ultimate lasting source of economic value is now flowing back into the physical world that has to power it all?